Here's a fact that should bother you. If your savings account is earning less than 5% right now, you are losing money every single day. Not maybe, but every day. Inflation doesn't pause because your money feels safe sitting there. Here's the strange part. Most people already know that. They've seen the numbers. They've felt the squeeze at the grocery store. And they still don't move a dollar. Why? Because the alternative feels riskier than doing nothing. So they freeze. And frozen money loses to inflation every single time. Guaranteed. Whether you feel it happening or not. Let's make this concrete instead of abstract. Say $58,000 lands in your account tomorrow. An inheritance, a home sale, a bonus, doesn't matter how it got there. No debt attached to it, nothing owed. What do you actually do with it? Almost everyone I ask says one or two things. Leave it safe or chase the growth in the market. Feels like the only two lanes that exist. And here's why nobody should feel behind for thinking that way. Nobody sits you down and shows you the third lane. Banks don't advertise it because it isn't in their interest. Most advisors don't bring it to you up either because it usually is not a product on their shelf. Hey, I'm Mario, and alongside building a real estate investing journey with my wife Lorinda since 2006, I've also spent the same stretch of years in the corporate world of finance. And running both those two paths side by side has taught me something the average saver is never shown. I'm here because I've been exactly where you are with that $58,000, wondering what to actually do with it. And sharing what's actually worked is honestly the best part of what we do. If any of this adds value to you, please like it, subscribe, and share it with somebody that you think it could help too. It means a lot to us, and it might genuinely change how someone else handles their money. Alright, back to the $58,000. Let's actually walk through what happens with option A and option B. Because the math matters more than feeling does. Option A, savings. At today's rates, you're earning somewhere around 4% if you're lucky on a strong account. On $58,000, that's a little over $2,000 a year. Sounds fine, until you line it up against inflation, which quietly eats 3 to 4% of that same money buying power every year. You're not really growing. You're mostly treading water, and some years you're losing ground while the statement tells you you're gaining. On option B, the market, historically it averages higher than savings over the long stretches. But it doesn't move in a straight line. You could be up 20% one year and down 20% the next. And if you need that money during the down year, the timing can cost you badly. It's not wrong, it's just not the whole map. Let's actually put a number on 5 years because it adds up over time. In a savings account, near 4%, $58,000 grows to somewhere around $70,000 before inflation, and closer to $60,000 once you account for it eating into the gain year over year. In the market, historically, that same $58,000 could land you anywhere from the low 80s to well over $100,000, depending entirely on which 5 years you happen to live through and whether you need to touch it at the wrong moment. 2 very different outcomes, and neither one is guaranteed. That's the honest version of both lanes. Here's the third door. Instead of putting your money into the bank or into the market, you put it into the exact seat that the bank sits in. It's called mortgage note investing, and here's the plain version. When a bank lends someone money to buy a house, that loan becomes a mortgage note, a real tradable asset. Individual investors like you and me can buy those notes directly. You don't own the house, you own the loan. The homeowner makes their payment every month, backed by a first lien position on that property. And that payment now comes to you. By the way, this week we're also breaking down an actual case file. A real mortgage that was declared completely worthless by its original lender. And what we found when we looked closer. That's Friday's video. This one is about the decision in front of you. That one is proof of what actually happens once you walk through that third door. Why would a bank or a private lender ever sell a note like this? And a few real reasons. They need liquidity now instead of collecting slowly over 30 years. They're rebalancing a portfolio. Or the loan doesn't fit their strategy anymore. None of those reasons have anything to do with what the note is being bad. Let me show you what $58,000 can actually buy in this world using real illustrative numbers. A homeowner has a note with roughly $63,000 still owed, 7% interest, a payment schedule already established, and years of on-time payments behind it. The current holder wants the capital back sooner than the 30-year term allows, so the note trades at a discount. In this case, around $58,000. Stepped in at that price and you start collecting the same monthly payment the bank would have collected, working out to be roughly a 7% illustrative yield, secured by real property. I want to be straight with you. These numbers are just an example, not a promise. Every deal is different and every yield depends on the specifics of that note. And you should always talk to your own advisor before making a decision like this. Before any of that happens, someone checks the fundamentals first. Loan to value. So the collateral actually covers the position. The payment history, so you know this borrower actually pays. And the lien position, so you know exactly where you stand if anything ever goes wrong. That's the real work behind the 7%, not a guess. But here's the actual point of that video. A and B were never your only two lanes. There's a third door that most people never shown. And it's the same seat that the bank has used for generations. If this is the first time you're hearing about mortgage note investing, that's exactly why we built this free 5-day Become the Bank challenge. 5 short videos, 1 a day, completely free, no obligation. And if you're already thinking this might be for you, the link is below to book a real conversation. So back to the question. $58,000, no debt. What would you actually do with it? Drop your answer below. A, B or C? I read every single one. And I appreciate you spending this time with us today. If you know somebody who could use a fresh way to think about their money, please send this their way. And if you got questions or you're just not sure yet, reach out. We genuinely love taking the time to talk through this with people. That's what this community is here for. I'd love to see you in the next video.